Hello everyone, welcome back to the channel. Today we are going to discuss the latest RBI Monetary Policy Committee decision announced on 1 October 2025, and the MPC has decided to keep the repo rate unchanged at 5.5% with a neutral stance. This is the second consecutive fall after two rate cuts earlier this year. Now, we are going to discuss the why does this matter, because repo rate influences our loan EMIs, deposit rates, inflation, and the overall growth of the Indian economy. Also, so let's break it down step by step: the policy decisions, inflation outlook, group projections, and what this means for all of us. The policy decisions repo rate unchanged at 5.5%. The MPC has taken an unanimous decision to keep the repo rate steady at 5.5%, and also the standing deposit facility is at 5.25%, and the marginal standing facility and bank rate at 5.75%, and the stance is neutral, meaning the RBI is not leaning towards either cutting or hiking rates aggressively. And now, why pause after earlier cuts? Because inflation seems to be well under control, but RBI doesn't want to take risks by cutting too much too soon. It's a balancing act between supporting growth and keeping inflation stable. In simple terms, cheaper loans could boost growth, but if inflation rises, households suffer. That's why RBI is flying safe. Now the inflation outlook. Here's the interesting part. Sorry for the background sound. Here's the interesting part. The RBI has revised inflation forecast downward, and CPI inflation for financial year 2026 is now projected at 2.6%, down from the 3.1% earlier. And the main reason are the GST rate cuts on some items, lower food prices, and strong buffer stocks of food grains. And quarterly projections are as follows. The quarter one is also given, and quarter 2 is 1.8%, quarter 3 is 1.8%, and quarter 4 is 4.0, quarter 1, that is financial year 27, that is 4.5%. This is important because food inflation has fallen to its lower since 2019. For ordinary families, this means grocery bills and daily essentials are not rising rapidly. For the RBI, this means more breathing space, no urgent need to hike rates. Now, come to the growth outlook. Financial year. Now, let's look at growth. The RBI has actually become more optimistic. GDP growth for financial year 26 is revised upwards to 6.8% from 6.5%, and quarterly breakdown is quarter 2 7% higher than earlier, quarter 3 6.4%, quarter 4 6.2%, and quarter 1, that is financial year 27, 6.4%. So India is expected to grow close to 7.0%, which is among the highest globally. What's driving this? So strong domestic demand and government spending on infrastructure and comfort of low inflation. And in simple words, the Indian economy is looking strong. The RBI is confident about sustaining momentum. So the last one is the implication. Implication. So what does the decisions mean in our daily lives? Borrowers, for example, borrowers, if you have a home loan, car loan, or personal loan, your EMIs will remain unchanged for now. Savers and FD and savings deposit rates will also stay stable. Markets and low inflation, stable policies positive for bonds and equities. Government and businesses, predictable interest rate environment makes planning and investment easier. In short, it is stability and predictability, both very important for long-term growth. Conclusion. To sum it up, repo rate remains unchanged at 5.5%. Inflation forecast is cut sharply, giving comfort on prices, and also the growth forecast is raised, showing confidence in the Indian economy. RBI is signaling we are in control and the economy is on the right track. Now here's a question for you. Do you think RBI should have cut rates further to boost growth, or was holding steady the right decisions? And drop your thoughts in the comments. And if you found this video helpful, don't forget to like, share, and subscribe for more updates on the economy and finance. Thanks for watching and see you in the next video.